Have you made these investing mistakes before, right? Well, today we're going to be going through this video by TastyTrade, which used to be called TastyTrade, now TastyLive. And this is called Don't Make These Beginner Option Mistakes. Now, I'm going to come at it from a completely different angle because I feel like the people over there do their very best to show you the worst way possible to trade and the best way possible to lose money. I lost over $200,000 trading this way. So we're going to watch this video. I'm going to give you some feedback, and hopefully I can help you not lose over $200,000 while still having an 84% win rate. That was me. That was me. Now, let's jump right into the video because this is going to get brutal, and I'm very excited about it. I've noticed that the blurring, I guess they can't use the name TastyTrade anymore, so there's going to be lots of blurs on the screen. It's not me, it's them.
Trade traps. Ready?
Yep.
So tasty bite accounts are $25,000 or less. It could be $2,500 to $25,000. We just picked a number for smaller size accounts based on the crazy old archaic pattern day trading rules.
Right.
So pattern day trading is anything under 25,000. So we just had to pick a number. So and margin accounts are anything over 2,000. So 2,000, 2,500 to 25,000. We call that a tasty bite account. So we decided to do a segment today on trade traps. Trade traps. I like
Trade
it.
traps.
Trade traps. We're gonna fire off.
That's 10 times fast.
For context, this is Tom. Tom Sosnoff. And I've actually met and interviewed Tom Sosnoff multiple times. If you want to go see, just go over to my channel, type in the word TastyTrade. You'll see Tom. The other guy that's talking, this is Tony Batista. I've also talked and learned from him directly. They have other people from that channel that I've worked with directly, like Pete Molmat. Dr. Jim Schultz actually was my personal trainer for a little while as well. Then there's Ryan, I forget his last name. Chris Butler, brother to Mike Butler, brother to Chris Butler, the one that we've been watching the options trading deep dive videos with. So I'm familiar with these guys, and these guys are familiar with me. This is not Chris talking out of his backside. Like, I've been around for a while, and I've had a chance to work with them. And I'm going to tell you right now, this is going to get ugly.
Yes.
We're going to fire off a ridiculous amount of information at you today, so you're going to like it, especially coming up after opening bell is another great market measure segment. Today we'll be covering earnings plays and kind of, you want to talk about time of the day to trade? Well, we did a whole segment on it. I think you're going to like it. So let's do trade traps first. For a trader just getting started, it's important to develop a solid trade approach to improve your probability of success.
This blurring is so freaking stupid and useless, and in my opinion, really, really unprofessional. If you're going to have videos up on YouTube, you don't need to be blurring out something for the entirety of the segment.
Today we'll look at some of the more common traps.
Fair enough.
Not a word we use very often, but something that we're just trying to...
Like, look at how useless this video is when you've got words that you're trying to teach blurred out.
Get more into the flow of the conversation. A successful trade approach should include should be statistical, mechanical, and logical. This includes
statistical, mechanical, and logical. Now, this is something that I do preach, right? Having a plan that makes sense, having a plan that is back-tested in a way that the worst case outcome is that you are wildly profitable. Wildly profitable. That's what I say is the only way that you should even start trading. Backtest your plan, paper trade your plan, and then once you can prove that you'll be wildly profitable in your worst case scenario, that's when you start putting real money into the market. Just putting that out there. We teach this all the time on this channel. If you want to learn how to do that, just subscribe. Right now, by the way, I really appreciate the super chat, Papacito. But do me a favor, don't ever worry about sending me one of those. And everybody watching, never send me any super chats, right? I really appreciate it, but you don't have to do that because I love this game so much. And I don't feel like you need to pay me anything for this incredible content that we try to put out every day.
HBT trades, proportionate sizing, consistent risk, proper strategy around binary events, reasonable time frame, giving yourself duration, and a proper exit strategy, which includes managing winners. This is stuff that we talk about all the time. It's just a small rehash. And let me tell you, when you think, sometimes we think, oh my God, we did this yesterday, we did this the day before, we did this the day before. Then we think about, we got to do this every single day forever.
It's correct.
And
'Cause
we
you always
have
get new people listening, and
not,
that's
it's
what
not
you
just
need,
new people.
repetition.
Last night I got an email from somebody that was on the trading floor for 30 years. And he's like, I've learned more I found you guys 3 weeks ago through a friend. I've learned more in the last 3 weeks than I learned in 30 years on the trading floor. He goes, where'd you guys learn this stuff? You're just like me.
Mm-hmm.
And I'm like, yeah, I know, but we've been gone for a while. You know,
Right.
so we got to spend some time. You're right. We're all just
We've
the same.
evolved.
Yeah.
Yep.
I'm not even sure if it's evolved. We've just spent a lot of time talking about it.
Well, you have to adapt. You have to change your trading.
It's repetition. Let's go next slide. So what are some of the things that can go wrong when a trader who attempts to implement a trade strategy around these concepts? I mean, it's not that easy.
These blurring out areas are going to drive me absolutely bonkers. Now I'll give you some feedback here. What are some things that can go wrong for a trader who attempts to implement I assume, trading strategy around these concepts? Well, first off, if you break the golden rule of leverage, which is never put yourself in a situation where you can lose more than you can make, you will be in a situation like me, where I had an 84% win rate and constantly lost money. That is one thing that can go wrong for sure.
And somebody else emailed me last night and said, Tom, I'm ready to go to the next level. What do I do?
Mm-hmm.
And just from the way they wrote the email, it's amazing the level of articulation they had about all the stuff that we just talked about. And I said, you know what, you kind of get it. The next level is just doing it more.
Right.
That's it. So you trade using high probability, but here's the problem.
Oh God, I'm about to get triggered. Okay, so now listen. As I mentioned before, I interviewed these guys. I've worked with these guys. So if you go back into my history, you're going to see me talking about selling options, right? I have evolved since then, right? These videos are from 5 years ago, 4 years ago, 6 years ago. So a lot has changed in that time. I have made a lot of money by not doing exactly this. Now, one of the things that you're going to see in my videos and in their videos is talking about high probability trading. Okay, so when you sell options, in fact, let's do this. Let me show you what a short put looks like. Okay, images. Okay, let me see which is the best image. Let's go with this one. No, hang on. Okay, let's go with this one here. Let me make this bigger. Open image in new tab. Cool. Let's say that you are selling options. In theory, and this is why they call it high probability. If you are selling an option and the current price is $100, it can go up to anything and you're profitable. It can stay at $100 and you're profitable. It can go down to 97 and you're profitable. So Chris got really suckered into this idea, this high probability setups here, where it's like, you know what? It can go up, it can go down a little bit, and it can stay where it's at, and I still make money in all directions, right? As you can see in this exact example, you may make $300. Doesn't matter how high it goes, you may only make $300. But if you lose, you're going to lose 2.5 times as much. That's just the start. For Chris, it was more like 6, 8, 10, 12 times as much just to get started here. You have broken the golden rule of leverage, but it's a high probability setup. So you tell me, do you want a high probability setup that puts you in a position to break the golden rule of leverage? Because this is exactly what we're talking about. High probability, because it can go up, it can go down, or it can go nowhere, and you're still profitable. You're still profitable. However, we got a problem. We got a big fat anchor on top of us right here, right? And not the anchor below us holding us down. It's on top of us, squeezing us down. So let's continue on. This is going to be brutal. Like, I'm not going to hold back.
The number one trap is not creating enough occurrences.
Okay. This I agree with, right? Now, let me pull up my slide deck real quick, and I'll tell you why I actually do agree with this. It's because, well, actually, let me introduce myself. I know I'm a random guy on the internet with a bone to pick, but my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. So go ahead and subscribe if you haven't already. Now, I wanted to talk about this slide in particular. Let me find it. It's our trading psychology slide right here. There are no expectations on the outcome of this trade. Now, it does align with what they're talking about there because it's occurrences, right? The number of occurrences do matter because if you have one trade, that one trade can be a winner or that one trade can be a loser. We understand that, right? However, given enough trades, you should come out on top if you have a profitable setup here. So let's go actually into my portfolio. And this is what I'm also trying to get across, right? When you look at this, any one of these trades that I put on could be a loser. Any one of these could be a loser. I don't know if it's going to be a winner or a loser just when I put it on. So you do need a high enough number of occurrences to create the data, right? So for me, my year-to-date return is at 55% right now. Annualized returns 135%. I would love to hit that for the year. That would be awesome. My average win is 50%, give or take. My average loss is 22%. And currently my win rate is at 56%. This is not, well, let me rephrase that. This is actually a fantastic win rate. I know you're probably thinking a 56% win rate. This guy doesn't know what he's talking about. But if every trade that let's imagine if you're flipping heads or tails, and on heads you win $50, and on tails you lose 22. I would flip that shit all day, all night, every day, no matter what. Because my wins are twice as big as my losses, and I win 50-50. That is a huge, huge way to trade right there. Now, let's flip this. Let's say if my win rate was 70. In fact, let's not just make it up. Let's do the math. Hold tight. Let's do the math. And this is why I agree with the number of occurrences. This is going to be a long video. This is why I agree with the number of occurrences. Because you need enough occurrences to create the data. So if I have a 55% win rate, 55.65, my average win is 49.53. 4953. My average loss is 2272. 2272. 2272. There we go. I already have positive expectancy on here, right? If I hit run, this is running 1,000 different simulations. And my worst case outcome is a positive $427,000 in this case. Let me repeat that. My worst case outcome is $427,000 profitable. Okay, that sounds amazing. Now let's change this and let's say that we have a high probability, right? Let's say following this that we have a 70-30. 70-30. Let's say that our win rate is 70%. Sounds amazing, right? Our average win, we'll keep the numbers somewhat consistent, 7,000. Our average loss is 3,000. All right, let's run our expectancy here. See how this pulls out. My worst case scenario, negative $16,000. That's not going to work for me. That's not going to work for me. Not at all. So let's continue on here. Oh, wait a minute. I did that backwards. I was like, wait, that's something doesn't seem right. My average win is 3,000. Yeah. My average loss is 7,000. Your expectancy is 0. Sorry, I was looking at it and I'm like, wait, something doesn't math right here. Your worst case, there it is. Your worst case outcome is losing $355,000. Your average outcome is still losing $3,800. And that is if you execute flawlessly. That is if you execute flawlessly, which we know that's not going to happen. So my worst case is horrible. My average case is horrible. Only in my very best case scenario do I pull out wins. And by the way, those wins are less than my worst case scenario if you have a completely different way of trading. Let's continue.
We've talked about this often, and number of occurrences seem to be the thing that has changed everybody's trading.
There is we used to know it, but we used to kind of know it in a roundabout way, but we couldn't figure it out. We used to know that the traders that we had throughout the years that we traded with, and we also used to know the traders that were the most successful of our friends. Like I had a friend that was a really successful trader, and he traded a ridiculous amount. He was like 10 times crazier than we were as far as just number of trades. He was ridiculously successful. Mm-hmm. And the reason is it's just number of occurrences. I don't think it was that easy to figure out. It's right in front of your face and it's hard to figure out.
Of course.
So for individual investors, the single biggest issue is not doing it enough.
Very good.
And I'm not sure that we can.
I can agree with that. Not doing it enough. Meaning, you don't know how many wins and how many losses you're going to end up with, and you need the data to come up with that. Another super chat came through from Papacito. I disagree on super chat. I pay because I now know how to trade better because of you. Super chat is for you to remind that you are cooking so hard. Wait, is there some sort of education you make? Like, first off, Papacito, you're way too generous. You're way too generous. Certainly don't ever feel like you need to send me a super chat. I love this game so much. But, you know, there was a great question, right? Is there any type of education or course or university? In fact, there is.
Are you ready? Let's go! Respect is earned. Respect is never given.
That's right. Every Tuesday and Thursday afternoon, we have a live class. We just had one yesterday afternoon, and we have multiple gentlemen who are actually in class learning directly from me. And these gentlemen are already putting up giant numbers, and we're not even halfway through. I mean, we're a little over halfway through the classes right now. And they're putting up tremendous numbers, right? Some of them, they've told me they're up like 50, 60% on the year so far. And we're not even through the class. That is how it's supposed to be. Now, here's the deal. 50% of you who watch and listen to OVTLYR University, it's just going to be passive. It's just going to go through one ear and out the other, kind of like this video might be for you right now. But 25% of you, you're going to take the strategies that I talk about and you're going to implement them, but you're not going to do them in the right way because you're not paying enough attention. And you're going to lose money and you're going to say, oh, this is all Chris's fault. Or you're going to try it once, and that is the one that happens to lose, right? Like I said, 56% win rate. It's the one that happens to lose, and you're going to say, oh, Chris doesn't know what he's talking about. I've lost so much money. Or the other 25% of you are going to create generational wealth. Generational wealth. And it will change everything for you, like these gentlemen who are in class right now are doing. And you know what? The university has a 100% money back guarantee. If you don't love it, I'll give you back every red cent you paid for it, because it's free here on YouTube. How does that sound? All right, let's get back to the video here. We have so much to go through, and we barely have even started.
Sugarcoat that, like you could read 1,000 books.
Yeah, but it goes counter to what everybody else says.
I understand. This is why I'm spending so much time on this right now. You could read 1,000 books. You could watch 100,000 hours of video, and ultimately, it's enough real-time occurrences that is the difference maker.
Sure. It allows you to be more diversified. It allows you to take advantage of different moves in the market. Trading small would be next, but go ahead.
I would put a caveat to that. Trade often doesn't mean trade whenever. Well, for them, it does. For them, it means, you know what, you should be trading all the time. I completely disagree with that. You do need occurrences, but you don't need to do anything until your plan is set up. We'd like to say, sit in cash and don't F up. That is an outlier idiom. Sit in cash and don't F up. If your plan is not there, don't do anything. Don't do anything, right? We have found that you can invest in a ETF called SGov and get paid daily interest based on short-term treasury bills, which is so cool, right? So you can sit in cash and not F up, or you can sit in SGov and not F up. But the point is don't be putting your money at risk ever when you don't need to. I want you to remember this. Write this on my tombstone. All stocks are bad, but every once in a while they act right.
I was listening to somebody talk about a discussion on professional athletes the other day, and they were talking about there's 400 players or something in the NBA. I think there's 400 players, around 400 players in the NBA, and 300 of the 400 are virtually the same.
What do you mean by that?
Meaning that the reason that they're in the NBA is because they worked harder than the 3,000 or 30,000 people that didn't make the NBA. There are probably 100, there's probably a handful of superstars. What, 30 legit superstars at different level. There's probably 7 players that are at a different level than the superstars. And then there's, 70, which is 100, 1/4 of the players in the NBA are at a different level. Then you get 300 players that are all at the level of, you know what, a lot of people could be here. A lot of people could be the 10th, 11th, 12th person on the bench.
In that small pool.
Which may be a pool of 3,000 to 30,000 people.
Mhm.
The difference is that the 300 people that are there in those last 5 or 6 spots on the bench have created enough occurrences. They have put the effort in to get to a different level to separate themselves based on number of occurrences.
Sure. Agreed.
I know that seems, I'm just trying to put an analogy up there so that because none of us can compete on a superstar level in sports, but there are, what I'm trying to say is that 75% of even the professional ranks of any business, many of us could have competed at different points, if it's not physical, but at different points in our life. We just haven't had the number of occurrences to get there.
Most of what we do on this show is because of number of occurrences and experiences that we've had. When somebody says like, why did you do this at that point? It's just because of number of occurrences and what you've seen in the past. It's typically how it reacts to that type of move.
We're going to have an intern on at 9 o'clock this morning who's working for us all summer, who I'm going to joke,
affectionately known as Willie T,
but who I'm going to joke with about there are certain aspects of finance now where I think he's more clear of the concept than any professor at Wharton.
And okay, so this came out in 2013. Of course, a lot's changed since then, including myself. Listen, they totally went off script, off topic, and I do that too. So I don't blame them for that. But one thing that I think get really wrong is they talk a lot of theory, like the person who knows so much more than the professors at Wharton, a lot of theory, but that theory doesn't translate into the market. Now, when I figured out I was so tired of losing was when I was working with one of my mentors. The most important mentor in my life was Steve Burns. You may or may not have heard of him, but Steve Burns is a professional trader, and he's been doing it forever, and he's written many, many trading books. One of my all-time top favorite trading books is called New Trader, Rich Trader, and he wrote that book. And I was working with Steve, and I remember specifically telling him about my option selling strategy, about how smart I was. And Steve said, "Oh yeah, I used to trade like that too." And then I realized I wanted to make money. I was like, "Wait, what? Wait, what? What do you? That's not the right way to trade?" No. And so I started working with Steve. Steve introduced me to a lot of people, and I got to work with Mark Minervini, one of the greatest traders of all time. And in fact, you can see some of the work I did with Minervini here on my channel. You can go to the Market Wizards playlist, and you can see all the market wizards that I worked with, including Minervini. But to that point, I remember talking to Minervini, and he specifically said, "Chris, this is why your trades suck. This is why your trades suck. This is why you're not making money." Specifically, exactly what they are teaching. So there are lots of random guys on the internet. I am one of them, of course. But if you're listening to random guys on the internet, you need to be listening to people who can actually vouch and say, "I'm making this much money. I'm understanding how the market works." Not, "I have this theory, I have this textbook, I have this this computer model, and this totally is how the market works." Versus the best traders of all time. The people who trade live on YouTube like I do, and you can follow along. And if you traded every single trade that I trade this year, you would also be up over 50%. I can't guarantee that, but I would assume you could be up something like this. And you cannot do that if you're selling options, if you're breaking the golden rule of leverage over and over and over.
Mean that. And all it is number of occurrences.
Not that he could get into Wharton, but yes, I understand.
It's just based on number of occurrences. It's the fact that once you actually start doing something, your whole world of finance changes. And what you originally thought finance was is something completely different after you make 100 trades. Then you understand capital markets, you understand liquidity, efficiency, you understand strategy, and your level, and you also understand...
You also understand bullshit.
Well, you also understand probabilities and how to figure out expected move. And as soon as that happens, your whole view of finance is completely different. That's based on number of occurrences. So he came here with no number of occurrences. Now he has whatever, a couple of dozen, probably in a couple of months, let's say 50 or 60 trades, whatever it is. All of a sudden, that number of occurrences puts you in a whole different league than every other kid at your grade level. It's fascinating. Not enough premium in sale, meaning that implied volatility is just too low. So there's not enough premium to sell out there. And so what happens is you end up with positions on that don't look like the positions you want to have on. You know, as
And the reason they don't look like positions you want to have on is because you're trading too often. You're trading too much. You're over trading because you don't have the setup you want to see. Now, when he talks about selling implied, selling options, not a premium when it's low IV. Remember this from earlier, right? Let's amend this. Let's change this to what he's talking about. If you're selling an option, this is no longer a very skewed 2-to-1, 2.5 to 1 risk to reward. We're talking more like $100 max win and $900 max loss. That was Chris. This right here was my wheelhouse all day. Dude, I have to trade all the time. These guys on the internet, these random guys told me that I need to be trading often. All right. And if I'm trading often, that means I got to take these subhard trades all the time. Right. So you know what? It's fine. I'll be glad to make $100 and risk $900 to do so. Wait a minute. Why do I keep losing money? Because now I need this trade to go perfect. Elsewise, it's going to take me 9 trades to make back. You can't do both. You can't trade often and get everything you want. You have to choose. You either wait for your setups as long as it takes. In fact, that's a quote from one of my mentors as well. Hold tight. Let me find it over here. No, not that one. Here. My 6 key rules of trading from Mark. Wait in cash for proper setups. How long? As long as it takes. You can't do both of these. You can't trade often and take everything that you want because it's not going to set up for your trading plan. You can't do that. You get one or the other. You wait for the setups that fit your trading plan, or you trade often. These are contradictory statements here.
Throughout the years as traders, we know when we have bad positions on. I can remember many times just looking at my stuff and going, what the hell did I do? Like, what was I thinking? This is not what I want to have.
That is exactly right. Don't you ever oh, Chris about to get fired up. Do not ever put on a trade, look at it in your portfolio and be like, oh man, what was I thinking? That was such a dumb move. First off, it should have never happened because it wouldn't have set up in your portfolio. Second, it should have never happened because even if you make a mistake, and I made a mistake earlier this week, fix the freaking mistake as fast as you possibly can. Take it off. If you log into your broker and it is not just full of green, you're doing it wrong. If you log in your broker and you see loser, 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 and you're like, that's fine, I'm waiting for it to come back. You are doing trading wrong. Kasha says, yeah, that was me. I got screwed hugely.
Have on. Mm-hmm. This is not the position that I want to have on. And I don't know how I got in this position. Like I just got too big an ego. I got too many dumb trades, whatever.
Listen to what he's saying here.
Whatever it is, position. This is not the position that I want to have on. And I don't know how I got in this position. Like I just got too big an ego. I got too many dumb trades, whatever it is. This is not the position I have on. So as retail investors,
you can't ever put yourself in that situation.
Have the luxury to be wrong.
Correct.
Remember, when you're a
you don't have the luxury to be wrong. That's interesting. I've been wrong 44% of the time and I'm making so much money. I'm okay with that.
When you're the casino and you're the house, you're the bookie, whatever it is, you have the luxury of being a little bit wrong.
It's a built-in edge there, sure.
Because you have a built-in edge. When you don't have that edge, you don't have the luxury of being wrong because you can't make it back.
Right. You gotta be on a
boom. Yes, and that's what we're talking about: expectancy and edge. Right? We plotted these numbers into the Monte Carlo simulator. Did I close it? No, I didn't. Over here, we plotted these numbers into the Monte Carlo simulator. Right? Their numbers come back horrible. Now, reason being is that their edge is not there. Now, you calculate the edge by taking your average win times your win rate. All right. In fact, let's do this together. Let's do this together. Let's pull up a fresh Excel so you can learn how to calculate your edge. Okay. Let me zoom in. You take your win rate, 56% equals 56 or 0.56, 0.56 times your average win. So we can even do times 0.495 or 49. Come on, 53. There we go. Now you subtract the average loss times your loss rate equals average loss 22.72 times your loss rate times 44 in this case times 0.44. Right, you take one minus the other. 1774. There you go. That is how you calculate your edge. Now, what is your edge? This is so cool. If you have an edge that's positive, even if you're down for the year and you have a positive edge, that means that given enough occurrences like they talked about earlier that I did agree with, you can expect that sort of result on average. So for example, if I put on 10 trades now, and if I put on 10 trades now, I don't know how big or small each win or loss is going to be. I have no idea. There are 4 possible outcomes: big win, small win, break even, or small loss. There is never allowed to be a big loss, ever. I don't know how big or small my loss will be on individual, but if I put on 10 trades or 100 trades, I can know on average, I'm probably going to hit pretty close to that as an average over those 10 trades. Some will be bigger, some will be smaller. So this is really cool. So if you have a profit target you're trying to hit for the year, and you say, you know what, if my average return per instance that I put on a trade is 17.74%, then I need to have 100 trades to achieve, let's use round numbers here. If I put on 100 trades, then I might hit 177% for the year. Isn't that cool? But you cannot force these trades. Here's the thing, right? You look at my portfolio, and this is sit in cash and not F up to the extreme, right? I went basically 5 months without doing anything. Put on some trades, went another month without doing anything. Put on some trades, went a couple weeks, put on some trades, okay? This is how it's done. And that's why I know I can use my edge and say, okay, over the next X amount of trades, I can expect to have this as a result over all of them, not individually, but over all of them, they should average out to that edge. Does that make sense? If this makes sense, type the word edge in the chat. Type the word edge in the chat.
100%.
Let's go back to the superstar discussion again. Superstars have the luxury of taking risk and being wrong. A Michael Jordan type player can miss 13 shots in a row if he has to, and he's still going to come out shooting. The 12th guy on the bench, he misses 3 in a row. He's yanked out of the game. He's not seeing playing time for the next month.
Right.
And that's the difference. You do not have the luxury of being wrong. There's not enough premium, which in this case means not enough premium to sell, or you are too close to at the money. So you've done kind of some stuff right, but you haven't executed the mechanics. I've had more than our share of emails over the years just suggesting that, you know, hey, I think I did everything right, but you didn't. I'll look it up, break it down. You're like, oh, okay. And that just comes from the experience of not enough occurrences.
So give me
Bro, I traded this way for years and years and years. I can't tell you how many occurrences. I don't know, probably 1,000, probably like 1,000. My edge was never positive. I didn't know that. I didn't keep track of that. And had I known that, I would have figured it out a long time ahead of that. But I had an inkling, right? I would go through the end of the year. I'd look at my portfolio and I would say, wait a minute, I have an 84% win rate, but I have less money in my account than I did at the beginning of the year. Where did I go wrong? And so my go-to was selling iron condors. I'll show you what an iron condor looks like. Listen, I got so jacked up into this world that I would dream about iron condors. I'm not joking, not exaggerating. I would literally dream about these. I'm like, oh my gosh, I'm gonna make so much money. This is such a brilliant trade, right? Let's go over here. Let's pop this one open. Open image, a new tab. There we go. Where it can go up, it can go down, or it can go sideways. Nothing happens, and Chris still makes money. The problem is that I boxed in the trade. So even if it went up, I was screwed. If it went down, I was screwed. Right? This is where I lost so much money, thinking I was a genius, that I had a strategy that made money if it went up, down, or sideways. And listen, this 200 and 300, that was not how I traded. No way. No way. It was more like 200 and 800. 200 and 800. That was more like it. Maybe, if I was lucky. A lot of times it was more like 50 and 950. 50 being the absolute max I could win. But it makes sense. Right? If it goes up, it goes down, it goes nowhere. Chris is going to make money all day. That's how you have an 84% win rate and still lose your ass trading. That's how you do it.
Tasty bite size account. What would
Yeah, Gene, right there. I traded iron condors and I thought I was a genius too. It's real, dude.
be like number of occurrences in a month?
So a perfect question. I do this with Case all the time. I want her at a very minimum to have the equivalent of 20 to 30 trades a month.
Okay, so you're talking about almost one.
At a minimum, putting on basically one trade a day. How do you reconcile this, Tom? How do you trade often and get 30 trades a month when you're not always going to have your high implied volatility, right? You can't rectify that. For them, it's more about putting on as many trades as possible. And I think it's because they had a broker association, right? Tom actually started the Thinkorswim. I don't know if you know this. Thinkorswim is one of the biggest trading platforms out there. Tom Sosnoff actually started that. Like, that dude created Thinkorswim. That dude's a billionaire, by the way. So it's in his interest to get you to trade. And then he went to found TastyTrade, which eventually turned into a TastyTrade broker platform. But you can imagine, if you're telling people you need to trade often, that generates more commissions and more sales for them. I think that at the end of the day, that was the entire goal. Trade as often as you can. Do these exciting, elaborate spreads, a zebra spread, an iron condor spread, or whatever spread, so they can generate more commissions. It's pretty devious, if you ask me.
On a day.
On average, yeah.
Mm-hmm.
But that could be in and out. You know what I'm saying?
Yes, I understand.
Right.
You're just talking about engagement.
Some Tasty Bites, I've seen customers with, $5,000 or $10,000 trade 4,000 times a year.
Mm-hmm.
Believe it or not.
Right.
And I've also seen people.
Yeah, because you don't need to trade all that often, right? Remember, sit in cash and don't F up. Sit in cash and don't F up.
With with that trade 14 times a year, so it really just depends. Let's go next slide. You trade with consistent size and risk, but you lose it. You trade too big in one trade. You just all of a sudden think, wow, this is too good.
Mm-hmm.
Okay, consistent size and risk. Now, those are actually two different things. Size, meaning how many contracts, can vary wildly. In fact, let's run this, right? Man, I'm so excited. I'm so excited. So you've gotten the basics of how to trade from me, but let's go. We got to go through like the plan. We got to figure out how everything is done, right? And so that's why we do it, right? So I always like to use these two examples, Coke and Tesla. Now, Coke, you could consider a boring stock, and Tesla, you can consider an exciting stock, right? These are $70 versus $297. A $1 ATR, meaning the average move over the last 14 days, that's the default, is $1.06 for Coke. And for Tesla, the average move is $13. So it's 13 times as much market risk on these. But if you're using consistent size and say, I take 10 Coke, I take 10 Tesla, that is completely different from what I try to teach, which is consistent risk. So if you're risking 5% of your portfolio here, the way that we have it structured, you actually risk a lot less because you keep your exit point so tight. It is by design supposed to be a quarter of how much risk you actually want to take. However, the option size, right, to have the same amount of risk, you would get 2 Tesla and 29 of Coke for the same amount of risk. Do not ever think that you can trade the same consistent size when you're looking at 2 different stocks. That will not keep your risk the same at all.
And if it looks too good, it is too good.
Right.
It's just
It walks like a duck, quacks like a duck, probably a duck.
We have the unique ability to pick the worst time to get big. It's a cultural. It's everybody deals with that. It's the major mistake in business.
Yeah, it is a major mistake, and all you have to do is formulate a way to consistently size your risk, and then you never trade too big. All the trades have the same amount of risk, consistency and risk.
I've used this example on the show before, but I just have to say it one more time. Helping out a friend once, somebody offered us a franchise for something, and I was the money behind it. I had no interest in running the franchise.
More money.
So I tell this story because it's one of my favorite. I thought I was way smarter than this. You can buy one franchise for 15,000, or you can have 10.
The volume discount.
Or you can have 10 for like 25. I'll take the 10.
Yeah, of course.
Never realizing I'm never going to get past the 1. So, or whatever it was, or you could have 10 for 30. Okay.
Right.
Why would I ever buy one when I could have 10 for 30? So, would you like to supersize that for an extra 15 cents?
Of course.
They do it at the movie theaters all the time. Hey, this size drink costs $4.75. But if you want 73 ounces, it's only $5.
Right. They do with popcorn too. You can get the popcorn bag, let's say for $3, or for an extra 50 cents, you can get the gallon size with free refills.
So I can eat 4,000 calories and be sick. Okay, but it's too big in one trade. Inconsistent risk in one trade can negate many small winning trades too.
Yep.
That's like all of a sudden, because we're too big.
Now that I agree with. Inconsistent risk can negate many small winning trades. And it's not necessarily that you need small winning trades at all. I would love to have much more bigger winning trades, right? But Mike the market maker, one of our students in OVTLYR University, had this exact thing happen to him. And he didn't do anything wrong. He did everything right. But he was trading on risk percent of 1%. Risk percentage of 1%. Making money, it made total sense. He sized up from 1% to 5%, because 5% is what I tell people is your absolute maximum. I don't ever recommend anybody going over 5%. Now, he moved from 1% to 5%. He did nothing wrong, and that next trade happened to be a loser. It just happened that way, because we don't know if any one trade will be a loser or a winner. Because that one trade happened to be a loser, it wiped out the profits that he had made previously. But had he had sized consistently, he wouldn't have even noticed it, right? So when you are looking to scale up your account, do it 1% at a time. Get used to that level, find that confidence there, and then go from 1% to 2%, 2% to 3%, right? Until you can reach that max size, which I recommend don't go over 5%. And it really is a real thing. Right. And unfortunately, it happened to one of our students. Right. But inconsistent risk in one trade can negate many small winning trades. Now, he's told me that because he's now traded at that 5% size for a while now, it's gone. It's not an issue anymore on that loss. But that can happen anytime.
We do something too stupid. And we do that all the time when we're gambling. Sometimes if we bet big, we won't double down. If we bet big, we won't split them because we just don't want to put more money up on the table. So one of the big problems with success is our own inconsistency. So if we're looking for kind of what our trade traps are,
remove that. Remove the inconsistency. Remove that by having consistent position sizing based on risk. Consistent position sizing based on risk.
It's too big in one trade. It's inconsistent risk in trades. And it is not enough diversification in our strategy selection because we get hung up on, hey, this worked for me last time.
That's right.
This worked for me last time. This worked for me this time.
Work again, right?
Yeah. So that's another thing that happens to us kind of all the time. Hey, this worked. I don't need to do that.
Of course. Keep going.
Yeah. Okay. So your trade strategy, in this case, your trade strategy around two binary events.
So I am a huge advocate of trading up into earnings. Let's see. There was one I saw the other day. Oh, I should have saved it. I don't remember what stock it was, but it had, if you remember in the chat, please tell me. We were looking at it and it had a nice, beautiful gap and go. Trading up into earnings is awesome because when you are buying an option, and it's coming up into earnings, the implied volatility is expanding, meaning that option is getting more and more valuable. It was American Airlines. Oh, I don't have trading be open just yet. Let's go to American Airlines. AT&T is also a really good one, but that one's a little bit older at this point. It wasn't American Airlines. I know AT&T works. AT&T had this absolutely. We'll just use this one. That's fine. Or maybe it was it Nike? Well, if it wasn't Nike, we'll go back to AT&T. Yes, it was Nike. Good call. Thanks, Ryan. Appreciate you, dude. This is awesome, right? Look at this. This is called a gap and go, right? Where it gaps up and then just runs. Now, a gap and go is where it doesn't close below the giant gap candle here. If it closes below the low of this candle, wherever the bottom of that wick is, that would be a gap and crap. So as it runs like this, that is such a beautiful gap and go. Now, we don't know what's going to happen at earnings, which is why buying an option before earnings and watching that implied volatility grow and your option growing in price is awesome. This one doesn't really fit the trend that I was looking for. Let's go back to AT&T. Somewhat. Let's say now this doesn't fit my outlier trend template right here, but it does have the gap and go associated with it. Let's say, for example, hypothetical, that you bought it here, okay, on this candle, and that option is getting more and more expensive, and the price is going up more and more. You get a double whammy. Your option is getting more expensive, which is awesome. It's helped pushing it up. Plus the delta, if you're buying call options here, plus the delta is working for you, giving you more intrinsic value, also helping the price of the option go up. It's awesome. Okay. However, in this style of trading, you know, you got to have all those occurrences. You got to be trading all the freaking time, right? In this style of trading, what they would do is they would sell a call spread and sell a put spread. This iron condor. Let me go to this one. This iron condor right here. Now the problem with that, as you can see right here, is they're like, oh, it's so expensive. Instead of buying the options and watching that option premium expand and getting out before earnings, mind you, that's what I do. I get out before earnings. What happens is it goes up, and then this can happen, or it can go down, and you get absolutely destroyed. The implied volatility comes in, of course, but the delta move is so crazy. The delta move is so crazy that, you know, when you thought you were a genius here and it just absolutely gets destroyed, you're at max loss before you even know it. You're at max loss before you even know it. So never, ever, ever sell options in general. And if you're going to do it around earnings, that is the worst time to do so, because you have just asked for all the trouble to be right on your doorstep.
First, not recognizing that data decay shows 2 weeks prior to earnings, which reduces return on capital by not closing before then. And two, missing earnings entirely. This relates to our overall market awareness. One of the things that, it doesn't have to be earnings, it could be any event. One of the things you can't plan for is, like, for example, what happened yesterday with the fertilizer stocks. There was no planning for those stocks opening down, whatever, $12, $14. You can't plan for that.
Sure. 30% move.
A 30%.
Man, I wish I knew what stock that was. We would go look on the chart right there, and I would bet you it was already in a downtrend. Already in a downtrend.
Move. There's no like, oh, ring the bell, there's a 30% move today. You cannot plan for that. The difference is that things that are known, I mean, I guess, you know, here, an example, I have always used lots of horrible sports analogies. The example here is the NFL is on a flexible schedule. So what that means is you have tickets for a game in early December, and you think it's a noon game, but all of a sudden they change it to 7 o'clock at night, and you don't know that. So
Right.
you show up at noon.
Okay. The blurriness, worth every moment we've had to deal with the blurriness for this right here. It looks like he's just like absolutely losing it. He's being censored.
Oh, I sometimes I'll have tickets to a game like a Bulls game, and they change it from a nighttime game to a day game. I missed the game. It happens all the time with baseball games too. You know, we call these flexible schedules. Well, the fact that you're not aware, that's market awareness.
Mm-hmm.
With our money, we should be aware.
I've always
So we should be aware of dividends, earnings, some things like that.
I agree with that, right? If you have your money in the market, it is always at risk. All stocks are bad. Remember this, all stocks are bad, but every once in a while they act right.
We don't have that much stuff to work on.
not that difficult.
That's right.
Mm-hmm.
I can say
engaged.
I can say over the years, have I missed stuff? Absolutely. Do I miss a lot of stuff? Not really.
You also have more positions probably than most people have. Also,
Of course. Improper time frame, duration selection, selling weeklies with little to no premium, or too much time to expiration leads to a decrease in return on capital. Data decay is much less for longer durations.
Okay. So what he's talking about here, selling weeklies. So trading the weeklies. I'm all about trading weeklies. In fact, in my style of trading, let's go to something more liquid. Let's go to maybe American Airlines is more liquid here. Yeah, it's got, you know, weekly contracts for as long as you want. My style of trading, I like to start at 21 days to expiration. So in this case, it's 23 days. I'll go one sooner and I'll go one later. That's pretty much my wheelhouse. That gives me 3 different options chains to choose from. So that's where I'm at, with little to no premium. So what they do is they sell these out of the money calls, these out of the money puts. And so, for example, this is actually a great example, right? Would you actually sell this out of the money for 18 cents? Meaning that the most you can make on this trade is $18. He's totally right about that, right? Your risk to return is so skewed. The very most you can make is 18 bucks. The very most you can lose is unlimited. Yeah, that's a real thing. That is a real thing. But if you're an options buyer, we want to minimize, because options buyers, if you do it correctly, can make the most money without a doubt. You want to minimize the amount of extrinsic value there. Extrinsic value. And where I like to be is around 20% or less. Okay. So in proper time frame, dude, find a time frame that works for you and go with it. Don't let anybody tell you it's improper. Second, too much time to expiration leads to a decrease in gains, basically, as the theta decay is much less for longer durations. So what he's talking about is this slide here, right? So if they are selling the option premium, right? If you go too far out on this, it's only going to move a little bit. And this is the word insidious is the perfect word for this, because if you sold this option, you have to wait and wait and wait. And it doesn't matter if it's 1 week, 1 day, 2 months, 2 years. You have to wait for that time to pass to get paid, because you're only getting paid on this time decay. You're not getting paid on delta, period. You're not getting paid on the delta, the actual move of the stock. You're only getting paid on time. Time will tick by every day, yes. But that time that ticks by every day is either going to be having the delta work, against you brutally, like it would have here if you had sold calls against this, or it might help you a little bit. It might help you a little bit if it happens to go in the same direction, right? But the insidious nature of it is, let's say that I had sold that iron condor on top of AT&T at earnings, and it blew through that, and it continued to run for like 2 months after that. The whole time, they would have told you, and I know they would have, because I heard this, and this is what I did, is don't worry about it. Prices always come back. It's the efficient market theory. It has to come back. It can't trend. I kid you not. The day I stopped listening to them was the day when they had a market analysis thing that came on, and they were like, trends don't exist. That was the end that I watched of them. And I was like, these are absolute fools. They are jokers, they are liars, they are scammers, because there is no freaking way to tell me or anyone out there that trends don't exist. Pull up every single stock. Go ahead, pull up every stock. You will find a time that it has trended. And then you also find times where it's not doing anything, right? To say that trends don't exist is so asinine, so idiotic, so stupid. Because I could literally pull up every single stock and find when trends existed, right? I'm literally clicking some at random, and you can see bullish trends and bearish trends, right? And, some sideways trends, sure. And then you can see big trends like this. And so their theory is, because trends don't exist, you can sell options all the time, and you got to put on at least one a day. This is how to blow up your account. This is step-by-step exactly how to lose money.
So let's stop here for a second. Improper time frame duration select in our selection process. Selling weeklies with little or no premium doesn't give us a lot of time to be right. We'll sell weeklies around certain events, but for the most part, we just need more time to be right.
Duration over direction, 100%.
That's it. He just literally said it. Right? You need more time to be right. Right? You need more. Let's go back to AT&T. You need more time to be right. This is what killed Chris's account. I need more time to be right. This is exactly letting your losers run and cutting your winners short. You need more time to be right. Let's say that we sold the options right before earnings, and then it blew through our options. So we're like, okay, you know what? It's fine. We just need more time to be right. Do you legitimately think that it's going to come back? Could it come back? Sure. Are you cool with waiting from January until July just to see if it comes back? I'm not. Right? Now, there's stocks like AMD that happen to come back, right? And at all these different points, that was from December to June. Yeah, yes, please sign me up for months and months of pain. Surely it'll go back. Surely it should go up from here. He's buying a ticket to Bagholder Village. Yeah, if it ever comes back. And like Apple, right? It came back from, let's just use this number here. Right? Let's say you were selling calls against this, and then those calls went against you, and it was brutal, and you're losing tens of thousands, maybe even hundreds of thousands of dollars on this one single trade. And you're like, oh God, please give me more time for it to come back. And then, oh, freaking finally it did. From April to June of the prior year to April. So basically 10 months for it to come back. How much money could you have made in the market doing other trades over 10 months before it finally came back? Tell me trends don't exist. That is where Chris got so hosed over. Baby, come back.
And I get so many emails from people, and it typically starts on the order entry and the timing that they're doing. If they're already trading small and they're trading often, they say, hey.
If you're trading small and you're trading often, all you're doing is pumping up your broker's accounts, right? You're pumping up the broker's income statement versus helping your account grow.
Hey, options expire. I mean, it makes common sense. I mean, it's common sense when you think about the logic. Options expire.
Thank you. I completely forgot about mentioning the options expiring part, right? Yes, you're going to get blown out, and then your options expire, and you're just absolutely wasted, right? Your options expire. You're at max loss either direction. You're at complete max loss, and your options have expired. You don't get the luxury of holding it all the way back like you would if you were a stock holder, right? You don't get that luxury. Your options are going to expire, and more than likely, you're going to get hosed.
Fastest the last week of expiration. Why not trade weeklies if I'm selling premium? But you know what? Everybody knows that already. And typically our direction is wrong. And what happens is we don't have enough time to be right.
Typically it's not wrong. 50%.
Well, 50% of the time you're wrong.
We don't have enough time to be right. So they're waiting on the time. Okay, this is really the meat and potatoes of how I can really get pissed at this. You're waiting because you have to wait. You cannot get paid selling options until time is ticking by, ticking by, ticking by. Finally, time is over, right? You're at expiration, but you didn't have enough time to be right because the market moved away from you.
Wrong. And,
for you, 54.
And that 50% when you're wrong it always feels like it's greater than the 50% time that you're right, meaning the magnitude of the move.
Oh, it's easy to be right.
Oh, yeah, freaking yeah. Because the 50%, if we're using 50%, the 50% of the time you're losing 2, 3, 4x 12 times as much as your wins. Yeah, that's why it feels so bad, because it is so bad. This is when Chris has got I should have started here. Man, this is getting me all hot and bothered now. By the way, we're 15 minutes into a 20-minute video, and I've basically been going for an hour. I can rant all day about how awful this is.
It's very difficult to be wrong.
Mm-hmm.
Yup, Senior Wahoo. Just roll it out in time so you have more time to be right. That was me. That is what these people teach right here. I'm calling you out to the floor, Tom Sosnoff. This is exactly what you teach. Just roll it out in time. You'll eventually be right. But yet you've locked up, on a one lot, you might lock up literally $20,000 to make $500. I'm not exaggerating here. If you're selling these positions naked, your broker may lock up 20 grand for you to make $500. So now I've locked up 20 grand for 6 months just to make $500, and it didn't work out. So now I got to continue to roll it and roll it and roll it. No. Don, good to see you, Don. I used to sell premium. I thought I was a terrible trader. Now I realized I got scammed. Dude, that was me. Don and I are brothers. Don and I are brothers because we had the exact same situation. I thought I was the genius here by doing this strategy, but I kept losing money. And I'm like, am I the only one that keeps losing money? No, dude. No, dude. This was you. This was me. This is if this has happened to you in the chat, I would like to feature you. Do me a favor. Tell me your story, right? Beam says, I used to sell puts and thought I was smart by picking up the pennies. And then you got hit by the steamroller, right? Where's the blowhorn? Yeah, let me get that out real quick. Thank you very much for that reminder. Sarah. Yes, I'm gonna have to pull that bad boy out. Let's see. I have a fever for more bullhorn. Beam says I lost 21,000 from profits by selling his puts. Let's see. By the way, somebody left me a YouTube comment the other day. I won't feature it, but they were like, Chris, you're doing it wrong. You need to be doing this, 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 and this. And at this point in my life, I'm like, bro, if you're making that money, you're so much smarter than me, because apparently I'm the only one who couldn't do it correctly. Let's see. Sylvia says, I actually was profitable selling premium on SPX, but I couldn't deal with the stress. That's real. That's real. Joachim says, I sold options as well, and he got monkey hammered. Yeah.
And yeah, so we like a little bit more duration, and then too much time to expiration leads to a decrease in return on capital, as theta decay is much less for longer durations. When would you go to longer durations? Well, when volatility is really high.
Right.
Because when you get really high volatility and you can lock it up, like here, an example would be a mortgage. If your mortgage rates are zero, or I'm sorry, not zero. If your mortgage rates are like 3%, and somebody says, would you like your loan at 3% for 1 year, 3 years, or 30 years? I'll take 30 years, right. Don. I'll take 30 years, or Alex. I'll take 30 years, Alex, behind door number 1. Why wouldn't you at 3%? I mean, how long are 30-year rates going to stay at 2.55 or 3%? They're already, the 10-year rates are there now.
Right.
That makes total sense to me. But are you going to lock up a 30-year? I mean, I'm sorry, you're going to lock up a 3% rate for 1 year when you know you're going to be in that house way longer than 1 year? Just makes sense. If something's really cheap, you lock it up. If something's really expensive, like I don't want to lock up a 20%.
By the way, for a little context here, I did consulting for credit unions for how many years was that? 12 years? Yeah, 2013 is when I started doing that. And then just in March this year, I left my day job, which is super cool. It was very scary, but the best decision I ever made. During that time, specifically what Tom was talking about there was interest rate risk. So I'd work with these credit union executives and showed them how risky their balance sheets were if rates were to go up or if rates were to go down, right? And of course, that there were lots of times where these institutions, I'll give you a perfect example of one institution who thought they were geniuses and absolutely got destroyed. And this is exactly what happened with several bank failures that happened over the last few years or so. Is this one particular credit union took out tons of mortgage-backed securities, and these mortgage-backed securities were right around, let's say, 2.5%. They were not expensive, or they were not high yielding, right? These credit unions were making investments, just like if you were to go get a CD. So they were using these mortgage-backed securities, and the yield on them was so low. But then the market started pushing up higher. All the interest rates started pushing up higher. And then these investments, when they first bought them, were worth basically 100 cents on the dollar because that was the market rate. As all of the interest rates went up across the board, their investments got worse and worse and worse and worse and worse, right? So now they could go out into the marketplace and get that same investment for 5%, give or take. And so they've lost 2.5% on the market of today versus what they were when they booked it a couple of years previously. Then it might have been worth 60 cents on the dollar, right? Because nobody wants that, right? Who is going to take this investment that is now paying 2.5% when I could go out in the marketplace and get 5.5%, right? So a lot of institutions made those type of bets for a long duration, and by doing so, they lost a ton of value. And then when depositors get wind of, hey, you know what? If they need to liquidate that, let's say that you had $1 million at the bank, and they use that $1 million that you deposited, and they went out and bought that mortgage-backed security. Let's say you now need that $1 million, and you go into there and they're like, okay, cool, give us a couple days. We got to sell some things. That way we can pay you, right? Because they don't have $1 million cash sitting there. They may not even have $1 million to be able to pay you. So they have to go sell that investment to do so. Then they only get 600,000. And they call you up and they're like, listen, we need a few more days. That investment we made with your money, it actually lost about 40% of their value. And now give us a few more days. We got to sell some other stuff. And then you call your friends and you're like, bro, listen, they took my money and they invested it in something that is now down 40%. I'm getting all of my money out. You need to get all of your money out as fast as possible. That's how bank runs happen, right? Totally not in regards to this, but since you brought it up, that is the risk. That is interest rate risk in a nutshell, right? If rates move, then it can totally take you out as an institution. Now, let's say, for example, let's relate that to trading, right? If the market moves and you're betting against it, right? Let's go back to AT&T. If you sold calls and AT&T looks like this and it's just going, right? The market doesn't want what you have to sell anymore, so they will punish you. They will make you lose money on that trade. I don't know how good of an example that was, but sorry, I totally went off script here. By the way, JJ says selling options was the biggest stress I have ever encountered. Right? Let's see. Why would you limit your profit and have unlimited losses? It makes no sense to me. I don't know. It seemed like a genius move to do at the time because it has a high probability setup, Ian.
It's an interest rate.
Right. I mean, everything is relative. Yes.
If I have a 20% interest rate, I'm going for 3 years.
Right.
If I have a 3% interest rate, I'm going for 30 years.
Of course. But you don't know if the 3% is going to go lower.
This is, of course, the case.
Mm-hmm.
Let's go to the next second to last slide. Selecting an exit strategy, not exiting when a
Sean, great story. He sold covered calls and naked puts for 7 years. He lost $19,000 over that time with an 80% win rate. Picking up nickels in front of a steamroller is very accurate, right? So Sean, really, really appreciate you sharing that story. He went 7 years and his total outcome was losing $19,000, but he had an 80% win rate.
Assumptions change. A huge problem that a lot of people have because they're looking at their stock and they're not looking at their marketplace assumptions or their portfolio assumptions, which is not actively managing winners and allowing them to become losers and then timing exit around moments of illiquidity. There are
not actively managing your winners. I'm telling you because I know what they say, and that is if your max profit in a trade is $200. They will tell you to manage your winners by taking it off at $100. Now, this is awesome. Okay, this is so great. Let me tell you how brilliant it is to cut your winner in half. We're not cutting our loser in half. We're cutting our winner in half. So using this analogy here, okay, we're going to take a screenshot and we're going to compare just how really bad this gets. So starting here, our expectancy was 0, meaning I'm in the way. Our expectancy is 0, meaning there is no positive edge to this trade. 70% win rate, $3,000 average win, $7,000 average loss. Okay. There is no edge to this at all. Your worst case outcome is awful. Your median, your base case outcome is basically break even, slightly less. And your absolute perfect outcome is a decent return if you can get that. Now, let's compare when we take our our winning edge here, and let's cut it down by half. Okay, we're not changing anything else, but we're cutting our winner down by half. This is what they teach you to do. I'm not talking out my backside. I know what I'm talking about here because I lived it. I went through it. I interviewed these people. I spoke to them directly, and they said, do this. Take your wins and cut them in half. That way you're managing your winners so you can get paid faster. Look. This, I should have just started with this. If you think this is bad, just watch. If you think this is bad, you are going to barf when you see just how bad it gets. Okay, you ready? Run. Your expectancy right off the bat is losing $1,000 per trade. Okay, let's do a side-by-side. Remember, our average win with a 0 expectancy, our average outcome is negative $3,800. Our worst case scenario is negative $355,000. The only thing we changed was, quote, managing our winners, meaning cut your winners even shorter. Our average return, this was Chris. This is what happened to Chris. Our average return was negative $380,000. Our worst case outcome is negative $625,000. And our absolute, this is the greatest strategy of all time outcome was losing $124,000. This is why when Minervini said, Chris, this is why your trades suck. That was why. My expectancy was dog shit. It was this. And this Tom Sosnoff, I hope you get to watch this because you and I know we had this conversation. This is why it doesn't work. Your style, I should have started here. This is why what they teach you on TastyTrade will bankrupt you. This is the reason why option sellers lose their ass. You know this, Tom Sosnoff. I'm talking right to you, my friend. If I saw you in person, I would have this same conversation. You cannot make money selling options with this kind of expectancy. When you have a 70% win rate, you cut your winner down by half, and you still have the average loss being the same as it was. Your very best possible outcome, if everything goes right, is still a monumental loser. I want to cut everything out and just have that. Let's contrast that to how I was taught to trade by the market wizards. Receipts are on YouTube. Let's contrast this, okay? Let's take a screenshot of exactly how they would tell you how to trade. Hang on tight. And it just makes me sick to my stomach that I fell for it. Lots of other people fell for it. I mean, I'm honestly furious that I did this to myself. 55.65%. 56% win rate. 56% win rate. Average win, 49.53. And this is my actual returns this year. Here's my portfolio. Everything that I put on this year. You want to take a screenshot, take a look at it later, go ahead. Right? Go ahead. Return on capital on lots of these. 15%, 96%, 49%, 106%, 74%, -9%, -31, 100% win, 34% win, -9% loss. 9% gain, 45% gain, 45, 48, 49, -20, -21, +46. I mean, it just goes on and on. This is how it's done. Okay. So we take that and then we put this in here. Yes. And then our average loss, 22.72. 22.72. Run. My worst case outcome is a positive $450,000 compared to their worst case outcome is negative $625,000. There's $1 million difference between these two. There is $1 million difference. And we're talking about $1,500 and $7,000 on losses. $1 million difference on our worst case outcomes. Our average outcome, $647,000 versus negative $397,000. There is $1 million difference. $1 million difference in our base case outcome. And then we get to our best case outcome, positive $883,000 versus negative $124,000. That's $1 million difference. Every way you slice it, the way that I trade now versus the way I used to trade, had $1 million difference. And that's not like it's $1 million difference. No, mathematically speaking, their worst case outcome, their average outcome, and their best case outcome all result in six-figure losses. My worst case outcome is a $500,000 gain, basically. My average outcome, $650,000 gain. My best outcome, $900,000 gain. Oh, this isn't even compounded. This isn't even compounded. This is just linear. That's just linear, my friend. Compounded, it would look like a rocket ship to the moon. I wish this wasn't over an hour deep into the video. We should start with this somehow. But this is exactly how you just hose yourself over.
We tend to act when
By the way, this is what we're going to be covering every Wednesday from now on, right? Or at least for a while.
not supposed to act rather than act when nobody wants us to act. In other words, I use this, I have a saying, I use it all the time here amongst all of our trading, which is take the money when you can, not when you have to. There's no money when you have to take it. There's tons of money when you don't want it.
Right.
And it's always worked for us. It's worked for us trading wise. It's worked for us business wise. Take the money when you can. Don't take the money when you have to. And
Take the money when you can, meaning, and this is what he means by that, which is take half of your total maximum profit. When it gets to $100 here, take it. That is a very amateur way of trading. In fact, I know that there's got to be a slide about this. I know I have a slide about this. I don't know where that slide is right now, but point is, he cut his winner short. He specifically preached about cutting his winners short.
And don't regret those decisions. You're not going to sell
When
the
you
top.
take the money when you have to, you're either paying up or selling down.
You're doing something on somebody else's market.
right.
Okay. If I'm, let's use another baseball analogy. If I'm one day before the trade deadline and I got a sucky team and I want to get rid of a pitcher with a lot of baggage and a big contract, and some of their team needs pitching, they have to pay up to take that pitcher away from me. That's the only way they're going to get it.
Right.
Otherwise, they're stuck with the team that they have. That's why these teams unload talent with one day to go, because you can get a lot
Panic
for
mode.
it.
Right.
Well, it's not. Yeah, you get a lot for it.
I mean, right.
You sell something when somebody else wants to buy it. You buy something, okay, when somebody else wants to sell it. When you need to sell something, there's no bids.
No good ones, right?
The first time we sold our company, we thought the market on our company was 35% less than the offer. Okay, this is a true story. The first time I say the first time because it was multiple sales. The first time,
I'm pretty sure he's talking about Thinkorswim, by the way. And like I'm telling you, dude has way more money than you could ever imagine, and it's not from trading. It's not. It's from making brokers.
somebody came in and looked around and said, "Hey, you know what? I love your guys' company, and I want to buy it." Now, we had an idea in our head what it was worth because there was other people that wanted to buy it. Now, we didn't really want to sell it. I'm like, listen, I'm going to make you a market, but you're not
paid 35% over what you thought it was.
That's right. So I'm going to make you a market, and you're going to hate this market, but I don't want to sell. So I made a market, which was, again, 35% higher than I thought it was worth. And they go, done. What do?
I guess you got to sell.
That's right. Because you made a market 35% higher. And I tell this story and people are like, that's crazy. But then, you know what, whatever.
Right.
Okay. But that's what it is. And you sell when you have to. You don't necessarily sell when you need to. Look at all the companies that didn't sell when they could. And now when they try to sell when they have to, they're out of business.
Sure.
And you can just go through the list of public companies like that. And it's extraordinary. I mean, it goes from Dell all the way on down to, I mean, look, we laugh, we talk about the rally that Yahoo's had. It's trading at $27 or $28 right now, but they had a $34 bid on the table, cash. This is 4 years ago.
Right.
Okay. I mean, let's put it in perspective. While trading at times is trading at times is an art more than a science. Knowing what works and adjusting and what does not is the key to success. Lessons learned can be used as building blocks to help develop a more consistent and profitable trade approach. Just to recap some of this stuff, small accounts, mistakes are magnified over larger accounts because you have less room to make it up, and you have less opportunity to make it up because you have a lower probability of success in a smaller account. It's the nature of the business. So when you have a tasty bite-sized account, you have to be very careful about your mechanics.
And that's what they meant by adjusting. It's adjusting your mechanics, the entry, trading often enough, picking the proper strikes.
That's right. The takeaways from this are number of occurrences, the underlying mechanics that we keep hammering home time after time, and then not falling in love, with what you have on.
All right, we're going to stop there. Now, this was a 20-minute video, and I've gone at least an hour and 20 right now. I apologize for taking so long, but this is why I'm so passionate against selling options. Now, we've covered in our options deep dives not the mechanics. I certainly don't want to say the word that he's been using because it's not in that same way. The pricing, what they are, how they work, and things like that. Now we're getting into more of the nuances. I want to go to war with this as my battle cry, because this is how exactly I lost so much money trading exactly like they do. And I trade the exact opposite. I trade the exact opposite today. And I think that we can get all kinds of amazing content out of this. And I'm hoping that if you are new to our channel and you're watching this for the first time, you're probably like, this guy is crazy. But he might be onto something. I really hope that in the very least, I can help you with that. But if you're ready to start winning, or wait a minute, dang it, I totally screwed up my my outro there. If you're ready to save money, no, fuck, I did it wrong again. Save time, make money, and start winning with less risk. Click one of these 2 videos, and I hope you had even more. Have a fantastic day. We'll talk soon.